Hello and welcome to the August 2026 edition of Macro and Market Update. In this edition, we dive into China's influence on the Iran conflict, the evolving energy price story, global market shifts, and what high-frequency indicators say about India's growth engine. We also discuss the traction in the RBI's latest dollar mobilization measures and the evolving dynamics in Indian equity and bond markets. Let's start with the global picture. The Iran conflict has now lasted far longer than almost anyone expected, and it continues to disrupt the energy flows. But interestingly, the real story now doesn't appear to be the conflict itself. It is China's response. By aggressively reducing crude demand and drawing down reserves, Beijing essentially neutralized what should have been a major global oil shock. Oil prices, which could have easily spiraled, instead remained contained. And that single move showed the world just how much geopolitical leverage China actually has. And it doesn't end there. China used this moment to highlight a completely different economic ecosystem, one centered on solar panels, EVs, battery arrays, and yuan-based settlement. More and more countries are paying attention to this alternative system, and global markets have taken note of how the country is positioning itself for the next decade. But for now, let's get back to energy markets. While China is acting as a neutralizing force, yet some energy market tightening is still visible. The Strait of Hormuz remains partially constrained, and Brent has rallied back to the levels of 90s against US dollar versus 70 by the end of June. This is driven more by fundamentals than speculation. Brent could stay elevated over next 6 months. China is recouping its reserves at every opportunity. Europe's gas storage looks insufficient for comfort. US crude inventories are falling steadily. All of this support the energy prices. Now, this shift ties directly into the next big global theme, the pressure building in global bond markets. For decades, countries like Japan, Germany, and Korea have been major creditors to the world. But today, as defense-driven fiscal expansion accelerates everywhere, those structural buyers of sovereign debt are turning into borrowers. And when that happens, the entire global system starts drifting towards financial repression or yield curve control. In that kind of world, gold doesn't just act as a hedge, it becomes a strategic asset. Further, this precious metal seems to have found a flow, with China continuing to buy and geopolitical risks staying elevated. Now, let's turn to global equities. Globally, markets are undergoing a reset of their own. South Korea's Kospi had its worst month ever, driven largely by forced selling from retail investors facing margin calls. Semiconductor giants came under pressure, yet the fundamental of the memory cycle remains surprisingly strong. DRAM prices are rising, GPU rentals are expensive, and semiconductor earnings expectations continue to improve. In the US, market breadth has improved, but systematic trigger levels have also risen. That makes the market more vulnerable to any negative catalyst. Defensive sectors like consumer staples outperformed in US in July, and investors are rewarding companies with strong cash generation. All of this reflects a phase of caution. That sets the stage for India, a story of resilience but with important complexities underneath the surface. This month, we bring to you the underlying macro trends as deciphered from Q1 FY27 earnings and recent high-frequency data. Starting with the banking system, the most important trend is the steady rise in credit-to-deposit ratio. The challenge for banks today is not asset quality, which remains broadly stable across public sector banks, private banks, NBFC, and even MSME-linked fintech lenders. Instead, the pressure is on deposit mobilization and the rising cost of funds, which is compressing net interest margins. In the near term, FCNRB inflows and other foreign currency deposits should help ease funding pressures. But this is more cyclical than structural at a time when credit growth is expanding in India. Inflation is becoming a unifying macro theme. Input cost pressures are broadening rather than subsiding. Cement companies face higher power and fuel costs. Electrode manufacturers are dealing with expensive needle coke. Dairies are seeing milk procurement costs rise, and across consumer and auto companies, raw material and packaging costs are inching up. We are already seeing selective price hikes in FMCG, diagnostics, staples, and parts of industrials. But not everyone can pass through costs. Fertilizers, agrochemicals, and specialty chemicals are facing some of the sharpest cost-price mismatches. Exports offer one bright spot, though selectively. Two-wheeler exports have turned around meaningfully. Cables and wires, generic pharma, and IT hardware are seeing healthy export demand. Several AI-linked hardware segments are also doing well, but service exports have plateaued. IT services, the strongest performer of the post-COVID era, is now dealing with weak discretionary spending, ramp downs at key clients, and cautious forward commentary. One factor looming large is US trade policy. After India faced its toughest treatment under US IEEPA in 2025, the tariff landscape has moved through Section 122 and now Section 301 actions. India's relative position has improved. Our tariff bans are now similar to or better than those of peer exporters, but the framework remains unstable. Exporters and investors must assume continued regulatory churn. Weather conditions are another important headwind. The delayed monsoon and lingering El Nino effects have depressed sowing and pushed global food prices higher. Domestic food inflation is rising, although the transmission in India is never linear, thanks to buffer stocks and diversity of crop patterns. But agriculture-linked sectors such as agrochemicals, seeds, fertilizers are already seeing weaker demand and the risk of higher sales returns. There is a clear downside risk to rural incomes. Industrial production tells a story of two economies. Capital goods production remains strong, supported by corporate capex and healthy order inflows. But infrastructure-linked goods are moderating, suggesting government-led infra momentum is plateauing even as corporate capex holds up. India's energy indicators continue to reflect a clear duality. Electricity generation posted strong double-digit growth in May and June, but this was almost entirely due to extreme temperatures and delayed monsoon, rather than any genuine expansion in demand. Meanwhile, petroleum consumption has contracted for 3 months in a row, led by steep declines in naphtha and LPG. Even so, India has navigated crude procurement exceptionally well despite global turbulence. Energy demand is often treated as a measure of economic momentum, but the current readings are too distorted to serve that purpose. On the consumption side, the indicators still look solid. FMCG volumes, auto sales, personal loan growth, and consumer confidence readings all remain healthy. The question is whether this can sustain in the face of rising inflation, weather disruptions, and the fading GST base effect. Real estate is also showing divergence. Commercial real estate remains robust, while residential real estate is seeing early signs of moderation as affordability softens and the post-COVID pent-up demand fades. Strong developers continue to do well, but the broader momentum is slowing. So, overall, India remains fundamentally resilient, supported by domestic demand, a healthy corporate capex cycle, and a stable banking system. But inflation, weather risks, global supply chain shifts, and regulatory developments create a tactically uneven environment. This is a phase where pricing power, margin management, and sector rotation matter far more than top-line growth alone. On equity market valuations, India looks much more reasonable today. After a multi-quarter correction, the premium in MSCI India versus MSCI EM has moderated and the sentiment has cooled. This improves the medium-term return outlook. But higher global rates, elevated IPO supply, and persistent FPI selling imply that market moves may be more measured. Our allocation framework continues to prefer a 60-40 equity fixed income stance, skewed towards large caps. Finally, a quick word on Indian fixed income. The RBI's June measure have pulled in about $32 billion by the third week of July, including roughly about $8 to $9 billion in FPI debt inflows. This was essential because India's BOP had been in deficit for 2 straight years and would likely have stayed in deficit without intervention. Even with these inflows, however, the banking system liquidity remains tight, partly because of high government cash balance and partly because the RBI has likely been settling forward dollar liabilities. Banks are also dealing with high loan growth and thus elevated CD issuances. Interestingly, even with the elevated credit to deposit ratios, bank incremental investment in SLR securities has risen to about INR 2 trillion between April to mid-July 2026, as against 3 trillion of full-year investment last financial year. This can partly be explained by the fact that a healthy chunk of FCNRB money has come to foreign banks, which have a limited lending franchisee in India. These banks have parked their inflow into government papers. Externally, remittances are keeping the current account bill very low, but the rupee is still under pressure because of volatile Brent prices tied to Middle East tensions. It has hovered around 95 to 96.5 against dollar during the month. Rupee is likely to remain in a similar range through 2026. And that brings us to the bond market. Yields have dipped. 10-year G-Sec is around 670 level. Demand-supply dynamics in key segments of the fixed income markets are expected to remain favorable in the near future, which will keep yields supported. Beyond the immediate supportive environment, there remains a case for remaining cautious with respect to the medium-term trajectory. Valuations on the long end of the GSEC is no longer compelling. Inflation risks are rising, WPI has firmed, and the global backdrop remains hawkish. Market is pricing at least one rate hike by the US Fed this year. A domestic rate hike cannot be dismissed, and the market is pricing that risk. Beyond the near term, even domestic demand supply looks cagey. From an investment perspective, the environment points to a continued preference for carry strategies, with cautious and only a tactical positioning on duration. The shorter end of the curve and products positioned there remains attractive in the current context. Signing off for this month. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.